Oil prices are surging, and they're surging fast as tensions in the Middle East escalate. US crude briefly hit the $120 per barrel mark this morning, while Brent climbed past $110 per barrel before retreating. So it looks like the beginning of a new energy crisis, and it's not only energy because food prices will likely start rising as well. So bond yields continue to rise on rising inflation expectations globally. Equity markets around the world start the week with deep losses, and there is quite little hope in the horizon in the short run for this conflict to come to an end, meaning that volatility will likely remain on the menu of this week. So welcome to Swissquote's Daily Market Talk. It's Monday, 9th of March. I'm İpek Özkardeşkaya. We will talk about a lot of things again today. But before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So it's happening, ladies and gentlemen. US crude just hit the $120 per barrel level at the open this week before retreating to around $107 at the time I came to my desk, while Brent crude peaked at $113 per barrel level before bouncing lower. But both Brent and crude are consolidating above the $100 per barrel level this morning as hope of peace in the Middle East waned following the appointment of Khamenei's son as Iran's next supreme leader, a decision that didn't please the US at all. The choice actually suggests that Iran will not give it up to the US, and that means a potential prolonged war in the Middle East, which is, well, home to about 50% of global oil reserves and around 40% of the world's natural gas reserves. And about 20% of the world's oil and LNG flows through the Strait of Hormuz, making it one of the most critical energy choke points in the global economy, and which is presently closed. So US nat gas is up by 6% this morning as well, and the European TTF futures will likely open the week on a very, very ugly note. Now remember, China had already ordered its biggest refiners to stop exporting oil to prepare for a prolonged war, and the US will certainly be brought to use its strategic reserves to tame the pressures on oil prices. But the strategic petroleum reserves in the US currently holds around 450 million barrels, barely 60% of the full capacity, and far below the roughly 640 million barrels held just a few years ago. So that makes it a short-term buffer, yes, but not a durable solution to a prolonged energy shock that would result from the Middle East war. So let me tell you what's next. Oil prices will reach a peak at some point in time. Maybe it's already done, maybe there is more to come, but they will continue to fluctuate at elevated levels for a few weeks and maybe a few months. Eventually, and even if the war persists, we will see energy prices come down because the global demand will not hold at these levels. But during this period of time, the high energy prices will revive inflation around the globe and will have a notable slowing impact on global growth. And well, the euro area economies didn't wait for a new energy crisis to slow down in 2025, while things in the US aren't looking brilliant either. The headline growth number there is better than the Europeans thanks to massive AI investment, but that doesn't tell the full story. Friday's jobs report, for example, from the US is the latest example that the US economy isn't doing that well. Instead of adding jobs, the US economy shed 92,000 non-farm jobs in February. 12,000 manufacturing jobs were lost during the same month, and last month, so the months before figure, was revised down by 69,000. The unemployment rate unexpectedly rose to 4.4%, and wait, because the wages growth accelerated to 3.8%. That was also unexpected. Now, one bright spot, retail sales figure was stronger than expected as rich Americans continue to spend, but the combination of job losses and higher wages growth didn't necessarily inspire investors at a time where inflation expectations are rising roughly along with energy prices amid broad-based tensions in the Middle East that look like they are going to last, and soon the latter will be reflected in consumer prices as well. Hence, the weak jobs report from the US last Friday couldn't revive the dovish Fed expectations. The US 2-year yield that best captures the Fed expectations spiked to 3.63% on Friday following the data, and it consolidates near this level this morning again, while the US 10-year yield spiked to 4.20% level. And elsewhere, the picture is exactly the same. The global yields are pushing higher given the spike in energy prices this morning, on the thinking that every central bank out there will have to tighten its monetary policy to deal with the new energy crisis and the inflationary pressures that will come along with it. So Asian indices opened the week with deep losses. US and European futures are also deeply in the negative this morning, hinting at losses between 2 to 3% at the open. The US dollar, on the other hand, is better bid, and that's pretty much the only traditional safe haven asset that benefits from safe haven flows this morning, because even gold is down this morning despite the rising tensions in the Middle East. It has been unable to amass the safety flows, even with its reputation to be a hedge against inflation. Why? It's quite hard to tell, but according to a Bloomberg report on Friday, it could be that the Middle East war is disrupting gold flows as well. That report says that gold stranded in Dubai is being sold at a discount as grounded flights make it harder to move the precious metal, and is sold at discounted prices. Now, if the world markets are on fire this morning again, it's because energy is a big issue for inflation. As I said before, it makes up to around 1/3 to a half of CPI growth in the Western portfolio, and in times of market stress like this impact could be much higher. And it's not only energy, the food prices are also expected to be badly impacted by the Middle East trade disruptions. In fact, more than a century ago, 2 German scientists developed a process that changed global agriculture forever. Known as Haber-Bosch process, it makes fertilizer by combining nitrogen from thin air with hydrogen, and the process relies heavily on natural gas. That's one problem. And the Gulf region handles a large share of the global trade for this nitrogen fertilizers. That's the other problem. And nitrogen fertilizer is essential to modern agriculture and supports roughly half of global food production. Half of global food production. So with the Gulf countries in conflict and the Strait of Hormuz traffic near complete halt, it is a matter of time, probably weeks, before we start seeing global food prices start surging worryingly and fueling consumer prices higher, and they're also actually doing so because the food prices have already started spiking. So when the US prints its latest CPI update on Wednesday this week, investors will obviously keep in mind that whatever the print, well, next month's figures will likely be higher. And later thinking, the building inflation expectations in the US and elsewhere will likely keep the Fed and other central bank dollars away. The Fed will hardly cut its interest rates, for example, 2 times this year, as it was anticipated before the Middle East conflict burst. And well, if it does so, because yes, the Fed can still cut the interest rates if it wants so, say to please the White House or the US president, I don't know, well, the market will certainly not follow. Because even if the Fed cuts, investors could well refuse to buy an unjustified rate cut, so the sovereign yields could well trend higher despite lower policy rates, and the Fed's monetary policy may not get effectively transmitted to the market if judged to, well, out of scope. Remember the Fed's jumbo rate cut in September 2024. The US 10-year yield had rebounded 120 basis points in the following 3 months, guys. So no, the Fed cannot just cut the interest rates, and will probably not be able to do so this year if this war extends beyond a few weeks, and this is unfortunately what looks like is going to be happening. So let's see how the things unfold in the Middle East, but the chances are that we are going to have more tensions on the wire, and that will cause higher market volatility in the coming days. Higher volatility is opportunity, but for now, obviously, the market stress is going to be on the menu du jour, and it's always good to be careful and cautious in this type of period, and do not panic sell if you have the possibility to do so. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.